We are jumping straight in today, right into what is, well, the most confounding financial puzzle of the new year.
It really is.
If you follow the markets, you know exactly what we're talking about. This incredible, almost dizzying surge in China's A-share market. Our mission today is to figure out what is fueling that fire.
It was just an extraordinary start to 2026. I mean, the domestic A-share market, it hit 16 consecutive days of gains, brand new highs. The classic spring rally, the Chunji Zhaodong, it arrived with a lot more force than anyone expected.
Right, but here's the mystery, and this is what we're unpacking. It was a dramatic decoupling.
Completely.
While A-shares were celebrating, Hong Kong shares, the H-shares, the Hang Seng, they totally missed the party. They had, what, a little bounce?
Yeah.
And they gave it all right back.
They did.
Okay, let's get into this immediately, because on the surface, it makes zero sense. Both markets share the same fundamental macro backdrop, same economy, same policy goals. So the big question isn't whether China is doing well or poorly. It's what specific, structural and liquidity dynamics cause this massive split. Is the A-share market just wrong? Or is Hong Kong missing the point?
And that's our deep dive. We have to look past the big macro story and get, really granular. The answer is all about how money is flowing and what it's chasing or what it's avoiding.
So let's start with that engine, the A-share rally. Before we get too excited about these new highs, our analysis makes one thing really clear from the get-go.
Yeah.
This opening good performance is not because of some big positive change in the underlying fundamentals.
That is the essential starting point. You have to understand that first. If you look at the high-frequency data, we're talking real-time stuff like steel furnace operating rates, wholesale prices for meat and vegetables.
Right.
They all show a continuation of that weak domestic demand we saw at the end of 2025. So this rally, it is not built on some sudden robust economic turnaround.
Okay, so if the economy isn't suddenly booming, what in the world is causing stock prices to hit record highs? This is where it gets interesting.
This is the core thesis, I think, that ties all the source material together. The rally is being driven by, and this is the key phrase, excess liquidity chasing scarce return assets.
Explain that. Money rich, asset poor.
Exactly. You have a situation where money is just incredibly plentiful, but the actual things to invest in, the structures that the market agrees have good returns, are suddenly very scarce. There's just too much cash chasing too few good ideas.
That makes sense. A structural shortage problem, but amplified by all this cash. But wait, if there's so much money, why isn't it just spilling over into everything? The big, large cap, traditional stocks. Are investors actively avoiding them?
They absolutely are. And because there's so much cash, a consensus forms incredibly quickly on what the scarce asset of the moment is.
And everyone piles in.
Everyone piles in, leading to these rapid, exhaustive price spikes. It's super selective. If investors think, traditional large caps are still tied to that weak macro trend, they just skip them entirely. They're chasing the next policy story, the next hot new sector.
And what's the evidence for this chase?
Well, there are two main things. First, just look at the structural focus. The main action is in what the research calls scenic sectors.
Scenic sectors, I like that.
Yeah, we're talking commercial aerospace, non-ferrous metals, even speculative stuff like brain-computer interfaces. These are all about future policy, not current earnings. And so we saw small cap indices just blow past the large caps.
Because it's easier to move those smaller niche names.
Right. And meanwhile, traditional consumption stocks, the ones most tied to that weak demand, they lagged badly. The gains were all from valuation expansion, people paying more for the promise, not for actual profit.
So the market is basically saying, I refuse to pay for today's reality. I will only pay up for tomorrow's possibility.
That's a perfect way to put it. And the second piece of evidence is just the sheer scale of the liquidity surge itself. This was fresh capital. Year-opening money from insurance institutions, personal funds maturing and getting reallocated.
So this wasn't just existing money moving around.
No, this was a huge inflow. The A-share margin balance, so money borrowed by stocks, it hit an all-time record high.
Wow.
But the really staggering number is the daily turnover. It recently shot past 3 trillion yuan. That's a new high since September 2025. I mean, think about that. 3 trillion yuan a day. That confirms the excess liquidity theory isn't just a theory, it's a tidal wave of cash.
Okay, that paints a very clear picture. A-shares are all about these niche, exciting stories fueled by a ton of domestic cash. It's a powerful anchor, even if it's temporary. But that brings up the obvious question. Why can't Hong Kong tap into any of that.
And that's the perfect transition, because if the A-share story is about structure and funding, then Hong Kong's story is the mirror opposite. Its underperformance, which really started back in October 2025, it boils down to three core reasons.
Okay, let's hit number one.
Structural deficiency. It's simple. Hong Kong's main sectors are just not what the market wants right now. Those hot, scenic sectors in A-shares like aerospace, they're basically non-existent in Hong Kong.
And Hong Kong's traditional pillars, the internet giants, high dividend stocks.
All largely out of favor, even the internet giants, because they're so linked to that weak consumer credit cycle. The only, and I mean only, bright spot was innovative medicine, which was up about 13%.
That sounds pretty good.
It does, but here's the crucial structural detail. That whole sector is only about 3% of the Hang Seng Index. The index just isn't built to capture that kind of specific excitement. A hot sector that's only 3% of your index, well, it can't lift the whole ship.
Right. Wrong index at the wrong time. So what about the money? A-shares are swimming in it. Why is Hong Kong so starved?
And that's the second and maybe the most crippling reason. A weakened liquidity environment. It's getting hit from both the outside and the inside. Externally, overseas money didn't help.
I thought a Fed rate cut was supposed to be good for Hong Kong.
That's a common misconception the sources point out. The 10-year U.S. Treasury yield actually rose after the December Fed cut. So the global funding environment for Hong Kong, which is super sensitive to U.S. rates, offered basically zero support.
And internally, the southbound money from the mainland just dried up.
It was diverted and decimated. Southbound flows just collapsed from a daily average of 6 billion HKD in 2025 down to just over 1 billion in December. The A-share frenzy we just talked about sucked all that oxygen out of the room.
And there was a regulatory angle too, right? Some kind of forced selling.
Precisely. This is a huge internal problem. New regulatory guidance told mainland public funds they had to get their portfolios closer to their official benchmarks. And the data shows these funds were massively overweight in Hong Kong.
How overweight?
They were holding about 30.8% of their stock exposure in H-shares, when their typical benchmark is only around 17%.
Wait, 30.8 versus 17? That gap, I mean, given the amount of money in those funds, that's not a minor adjustment. That's a tidal wave of mandated selling pressure. They have to sell, even if they like the stocks.
That's the reality. And to make it worse, Hong Kong had a huge supply of new stock hitting the market. IPOs were really active at the end of the year, plus you had massive lockup expiries. So just as the inflow of money slowed to a trickle, the supply of stock for sale surged. It was a perfect storm.
Wow. Okay, so we've got bad structure, bad funding.
Yeah.
What's the third element?
The third reason is that Hong Kong is just more acutely reflecting the weak fundamentals and the credit contraction in China. Its index has a much higher weight in cyclicals like finance and real estate and consumer-linked internet names. When the credit cycle is weak, those sectors feel it first and worst.
Whereas A-shares are a bit more insulated.
A bit, yeah. They're supported by sectors with better earnings resilience, like external manufacturing and tech hardware. Right now, Hong Kong is simply a better and frankly more painful barometer for the actual credit health of the Chinese economy.
That split really clarifies things. A-shares are on a speculative cash-fueled high, while H-shares are just stuck, weighed down by reality. So let's put this A-share excitement in context. Is this spring rally a normal thing historically?
It is, and it's a really critical pattern. The spring rally effect is historically very strong, especially in A-shares. The research looked at the past 20 years, focusing on that policy-heavy window from the big economic conference in December through the 2 sessions in March.
And what does the data show for A-shares in that window?
It's pretty pronounced, and it heavily favors smaller companies, which, ties right back to our chasing scarce assets idea.
Right.
The A-share large caps, the CSI 300, they averaged a gain of about 4.6%, but the small and mid caps, they average gains closer to 8.5%, and with a higher probability of gains, around 70% of the time.
Because that's where the policy excitement is. And Hong Kong during that same historical window.
The Hang Seng average gain, a mere 0.5%.
0.5%. That is a stark difference.
It really is. It just proves how much more sensitive Hong Kong is to external factors and how it consistently struggles to participate in these domestic liquidity-driven rallies.
So 2026 seems, at least for now, structurally set up to favor A-shares. So how do we use this knowledge about fundamentals, liquidity, and structure to think about strategy?
Well, we have to recognize that fundamental separation. Looking forward, A-shares actually have a relative advantage in projected earnings growth just because of their sector mix. The data suggests A-shares could hit 4% to 5% earnings growth in 2026, which is better than H-shares at around 3%.
And why is that?
Purely structural resilience. A-shares have more exposure to things like semiconductors, which are projected to see net profits grow over 70%, or auto parts up 57%. H-shares, meanwhile, are getting dragged down by projected revenue declines in consumer services and durables.
And on the liquidity side, does A-share keep that massive advantage?
Absolutely. They have a powerful domestic anchor. There's a projected 32 trillion yuan in resident long-term deposits scheduled to mature in 2026. That money needs a home.
And Hong Kong remains tight.
Profoundly. Even in an optimistic scenario, the estimated southbound inflows for 2026 would only barely cover the expected capital demand from new IPOs and refinancings. It's just a very tight environment. It needs a big external catalyst, like a real sustained drop in U.S. rates, to loosen up.
Okay, so A-shares win on fundamentals and liquidity for now. Where does Hong Kong find its value for an investor?
In structural complementarity, H-shares are valuable precisely because they're different. They're where you find the internet giants, the best high dividend payers, the unique innovative drug companies, all categories that are scarce in the A-share universe. They are vital for diversification, even if the index itself lags. And this brings us right to the strategic allocation guidance. If the whole game right now is excess liquidity chasing scarce assets, then your strategy should be to follow the direction of credit expansion. That's what defines where the scarcity and growth will be.
And since the overall credit cycle is still pretty weak in areas like property and consumption,
you have to be very specific. The focus should be on 4 key categories for your AH allocation.
okay, what are they?
First, AI and the tech chain. This is the most scenic area with huge policy backing. A-shares are where you find the hardware, the chips, the infrastructure, which has more short-term certainty. H-shares are where you find the applications and internet side, but the monetization path there is less clear. It's more dependent on, say, U.S. catalysts.
Got it. Second is dividends, I'm guessing, is a defensive play.
Yes, exactly. Dividends are for balance and to hedge against that volatility from weak consumption. And Hong Kong has a clear structural advantage here, offering a much better dividend yield.
Cyclicals. Given the weak domestic data, where are the opportunities there?
Cyclicals are really just a Q1 focus. The opportunity is driven by a potential repair in U.S. demand, so think metals, chemicals, machinery, which are more present in A-shares, or a lagged rebound in domestic producer prices. It's more of a short-term tactical trade.
And finally, consumption. This seems to be the toughest nut to crack.
It is. It's just lacking immediate fundamental support. So the research suggests one of 2 things. Either you do short-term trading on policy news, or for the long-term player, you adopt a deep value approach.
You mentioned that strategy earlier, losing time but not space. Can you just unpack that for us?
Sure, it's a strategy that requires extreme patience. You find businesses with really deep competitive moats that are trading at historical lows. You have to accept that you might lose time. Your money might be stuck, not doing much for a year or 2, but you gain the assurance that you won't lose space.
Meaning the downside is limited because it's already so cheap.
Exactly. You're just waiting for the eventual, inevitable fundamental recovery. It's an approach built on deep conviction, not on chasing quick gains. So to synthesize this whole deep dive, the divergence we're seeing is at its core a temporary liquidity phenomenon. You have domestic money, flush with cash, piling into a few niche, high expectation areas in A-shares.
While H-shares are stuck reflecting a more vulnerable mix of weak fundamentals and really severe liquidity constraints.
Exactly. A more accurate reflection of reality, for better or worse.
And this structural chase, this liquidity party in A-shares, it's all happening long before the actual fundamental cycle has repaired itself. The analysis we looked at has models showing that M1, the money supply, typically leads PPI, which is producer inflation, and a proxy for fundamental reality, by 6 to 9 months.
Yeah, the implication there is staggering.
It is. We're watching the market engine rev up right now, but the actual fundamental repair might not even show up until, Q2 or Q3 of 2027. So if this rally is built on a liquidity impulse that runs out of steam before the fundamentals arrive, what risks does that imply for its sustainability? And maybe more importantly for you listening, what specific indicators should you be watching to track that inevitable shift from a liquidity-only party back to fundamental reality? Something to consider.